This is going to be Chapter 1, Video 3. Let's launch. Okay, so our learning objectives today is going to be to describe the different tax rate structures and calculated tax, identify the various federal, state, and local taxes, and then we're going to also apply criteria to evaluate alternative tax systems. All right, so there's basically three different types of tax rate structures, and contrary to popular belief, we actually have all three of these in the United States. I know a lot of people, most people know about the progressive tax rate because that's kind of in the news all the time, but we actually have a system that does proportional tax rates and regressive tax rates. So what is a proportional rate? A proportional tax rate, sometimes referred to as a flat tax, poses a constant tax rate throughout the tax base. Now you might say, hey, wait a minute, what kind of tax is going to be at a constant rate? And a very good example is Medicare tax. It's something that everybody pays, and it's going to be done at 1.45% for employees, 1.45% for employers, regardless of the amount of money you make. $100, I'm sorry, well, actually, no, because if you make more or less than $400, you don't pay any of that. But if you make, $10,000 or you make $10 million, that's exactly how much you're going to end up paying on all that. The progressive tax rate system, that's where basically as your income goes up, they're going to take and they're going to actually change your tax rates to go up. And again, I've talked a little bit about this quick finder, and what we have here is we got the tax rates. I'll see if I can get that a little bit closer up for you guys. Those are going to be your tax tables, and then they're at various rates. We'll talk about each of these, these sections here. You got married filing separate, married filing joint, single, head of household, married filing separate, and what the rates are. And then as you go from like $0 to $19,000, you pay 10%. From $19,401 to $78,000 and change, you go to 12%. From 78 and change up to 168 and change, you pay 22%, and so on and so forth. And so what ends up happening here is as you go higher and higher, you take it. Now, some people might say, hey, is this fair? Is it really fair that we go after people who actually make more money and are more successful? Here's a retort that I've actually used against this is it all comes down to affordability. And if you think about it, I have in my pocket right now, I have a $20 bill. I'm not going to pull it out because maybe I'll get in trouble or whatever. I got a $20 bill. And if I go to some friends of mine, and we're all CPAs and we're all very successful in this stuff, and I'm like, I'm going to pay you $20 to come and clean my office. I guarantee you, not any of my friends are going to take that $20 to come clean my office, especially if you take a look at how bad my office is. If you take a look at how bad my office is, you'll be like, I don't know, man. I don't care how poor you are. I'm going to need more money to do it. But if I go to a college student and say, hey, I need my office clean, here's $20. There's a lot of people who end up doing that. And the thought process is when you have less amounts of money in your total control, the next dollar is more valuable to you than it is to say Bill Gates. Bill Gates probably loses $20 on his couch every day. I mean, he probably spills $100 bills in his couch or something of that nature. Okay, what ends up happening is that when we take a look at this, Bill Gates, $100 is probably less valuable to him than $20 is to you as a college student. And so I think that kind of makes some sense. And that's kind of why, progressive tax rate, in my personal opinion, does make a little bit of sense. And, again, I do know there's another argument that basically says, why should we be taxing people who work harder and make more and blah, blah, blah? Why should we be taxing them more? And that's a fair question. But at the same time, we need to kind of balance that out with the other object, which is, am I going to go to somebody and tell, who makes $12,000 a year and say, you're going to pay, $4,000 in taxes versus, somebody else who makes, $400,000 a year and say, you got to pay a third of your income in taxes. It's going to hurt the poor person far more than it's going to hurt the rich person, because the rich person, chances are, is making enough money on the other side in order to be able to enjoy a comfortable lifestyle. Now, the regressive tax rate structure, it imposes a decreasing marginal tax rate as the tax base increases. A very good example of that is actually the Social Security. And so the Social Security base, I don't think I have it here on this. I don't think it shows up on this one quite. It used to. But I know it's like 132,000 and change. And like I said, it changes every year. So and that's something I'm going to also tell you. You don't ever memorize stuff in tax. It changes all the time. So you just don't memorize it. You just know where to look it up if you've got to. And I know there's a place to look it up, and I'm not going to take, valuable video time in order to demonstrate my research skills here. I'll do that in the tax research video, which we'll be doing later on. So that's how we all going to talk about that. Now, would a chart look if we map these three out? And bada bing, bada boom, here it is: proportional, progressive, and regressive tax rate. And I like to call this the tax star, because there's not a whole lot of stars in tax, other than, I do know a couple of people who are stars in tax. At least they think they're stars. But anyways, they are who they are. Types of tax: you've got federal taxes, which are going to be income tax, employment tax, excise tax, transfer tax. A good example of an excise tax. I know that there was some big talk about, we're ticked off of the French are doing something against us, so we're going to put an excise tax on their wine imports. It's a tariff, but we can also do excise tax. So, for example, if we know that somebody's bringing in, a product and it's a lot cheaper, maybe, in order to make it a little bit fairer for, local competition, they'll put an excise tax. I mean, they do these for various reasons. Free market guys obviously don't like them, but, they are what they are. We've done excise taxes pretty much since the country was founded. And so, and all that. And then transfer tax is a very good example. If I do a gift to somebody, I'm going to pay a gift tax. If I die and I, send, $80 million to my son, he's going to pay an estate tax on some of that. I mean, $11 million of it's going to be gone, but is what it is. And then you got state and local taxes. So you've got income taxes, obviously sales and use tax, property taxes, and excise taxes. Again, a lot of these taxes are the same as for federal. Obviously, federal, we don't do property taxes, and that's just because of the way it is. Property taxes generally, the reason why it's done at the local level is better to be managed that way. And usually there's not a whole lot of, it's basically the local government says, your house is valued at this is the rate that we're charging, you're done. Now, you can appeal that if you want to, but for the most part, you don't go out and fill out a property tax form. And unfortunately, at the federal government level, if they were to do that, they'd have to do something like that because it'd just be unmanageable otherwise. And they do offer excise taxes and usually when you're talking excise taxes, it's going to be taxes on units of product as opposed. So very good example, you buy a pack of cigarettes, you're going to pay an excise tax, or sometimes they call them sin taxes, but you're going to pay a tax in order to be able to do that. Sorry, I kicked my microphone stand and I didn't know if it was what it was. And then you've got implicit taxes. I'm not going to talk about these too much, just because we're just not. So federal taxes, income tax represents about 56.5% of all tax revenues collected by the United States. Individuals, 43.3%. Corporations, 9.2%. Wow, that doesn't seem fair, does it? Well, let me explain something to you. That's actually very true. But the other thing that you've got to understand is a number that's not factored into that I think is very important for people to understand: small businesses. Okay. So if I have an S corporation, a partnership, or any of that other stuff, that goes on an individual's tax return and does not get calculated as a business corporate tax. So I think that number is drastically skewed, and for that various reasons. So I would be a little leery about that. Okay. So you can have it levied on individual corporations, estates, and trusts. There's also some additional taxes that can exist, but we won't get into that. I mean, nonprofits can also pay tax because it's going to be what they call UBI, unrelated business income. So, like, for example, if I've got say for example, there's an animal sanctuary off in the middle of nowhere, but they sell products of clothing. That's going to be what's called a UBI item. So they're going to have to pay taxes on the sales of that. Unemployment tax, the second largest group of taxes imposed by the United States. Employment taxes include the OASDI, which is Social Security tax, and the MHI, which is a Medicare tax. The Medicare tax is actually 12.4% divided by 6.2% for individual people, and then employers pick up the other half. And then the MHI tax, which is 2.9% divided by 1.45 for the individual, and then 1.45 for the employer. And so they basically do this in order to fund Medicare and Social Security benefits for today, with an expectation that the younger generation will fund it for for myself when I retire. So continue working hard so that I can retire very well, and I would really greatly appreciate that. Sorry, I'm kind of joking. But anyways, unemployment taxes, fund temporary unemployment benefits for individuals. Yeah, the unemployment one, FUTA is what it stands for. That's federal unemployment tax. So FUTA, and then you also have what they call SUTA, which is state unemployment tax. We call these the FUTA, SUTA, FICA, whatever, and all that sort of stuff. Obviously, we're right now in the middle of COVID-19. A lot of people are unemployed. They're taking benefit from that. So it's an insurance scheme that that the federal government came up with, and it works in conjunction with state unemployment taxes so that they can be able to best and issue out benefits in a most efficient manner. All right. Excise tax, third largest group. This used to be the number one, believe it or not. We used to do a lot of export taxes, a lot of excise taxes, and it is levied on quantity of products sold. So, for example, you may get an excise tax on barrels of whiskey. You may get it on barrels of wine. You may get it on heads of cheese or pallets of cheese. And I'm trying to think of like some large units. So you may have that excise tax that takes place. Then estate and gift taxes levied at fair market value of wealth transferred on death or by gifts. That, yes, that is more often than not, though, most people will qualify for an exemption from all that, so they won't have to pay any of that. But there are going to be times. I've actually worked on a lot of gift tax returns. Good news is they take about 45 minutes to do, 45 minutes to an hour max. So they're actually, whiz bam boom done. So it's actually a good deal. Okay. And the most important thing is not to be afraid of the gift tax. Most people get the gift tax and go, whoa, I don't know what to do with this gift tax thing. More often than not, you're going to have examples that you've done that other people have done in the past. You're just going to, it's going to be a lot of copy paste. You may have to collect some Social Security numbers, so on and so forth, but they're actually pretty self-explanatory, and the tax system actually usually takes good care of them. Okay, then you got state and local taxes. Biggest one that most states and will have, in addition to income taxes, is going to be sales and use tax. That's for sales tax is on the retail sales tax for the retail sales of goods and some services. Base tax for the use tax is the retail price of goods owned, possessed, and consumed within a state but not purchased within the state. Sales and use tax is pretty much based on the same concept. So if I go down and I buy a sandwich at a place and say they charge sales tax on that, I pay 6% on the buying of that sandwich. But in theory, and again, some of this, doesn't get collected as much as possible. But if I go buy a sandwich and then cross state lines, come back home, like I buy something in Maryland and I come back here, technically I'm supposed to pay a use tax on it if it's subject to sales tax within my state. Obviously a sandwich is probably a bad idea. Good example is a TV screen. Like I've got a TV screen right behind you that you can't see, but it's a 75 incher. If I bought that in Maryland and brought it back here to the state of Virginia, technically I'm liable for use tax on that. Now, in this case, I actually bought it from the military base, so they didn't pay sales tax on it because I didn't have to, because that's an exemption that you can actually have from sales tax. Property taxes, they're allowed property taxes are ad valorem. That is the key term, ad valorem. What does that mean? It's Latin for based on value. In other words, if they come to you and say, look, your house is valued at $150,000, we're going to charge you 3 cents for every dollar. You do the math, and that's how you kind of figure it out. All right. If they come back to you and they say, we're just going to hit everybody for $100 a pop, that's not an ad valorem tax. You can't use it. Can't deduct it. Okay. So that's technically not a property tax. That's going to be a levy. But it's going to be a different type of levy that's not going to be deductible, unfortunately, unless it's a business and you have to do it. It's going to be considered, under Code Section 162, it's going to be allowed as a required business expense, but, that's neither here nor there at this point. Real property tax consists of tax on land and structures permanently attached. Personal property taxes here in Virginia, we do pay a personal property tax, oftentimes called the car tax, but it's not just on cars. It's also on a whole lot of other things. Most people just don't have to pay it, but businesses do. Like, for example, all this stuff that I have in my office, I have to pay taxes on if I own it. Now, some of this stuff I don't own, so I don't pay tax on it. The guy upstairs does, but the other stuff is usually paid for by them. Okay. Income taxes. Most state income tax calculators largely conform to the federal taxable income calculations with limits of certain modifications. And that's pretty true. And we're not going to talk too much about state taxes in this class, but most taxes, some states will actually do a tax based on, what we call the gross income method, which is basically they take gross income. It's just like a regular tax return. Gross income minus deductions equals taxable income times tax rate equals tax. And then others will basically say, we're going to use federal AGI as the starting point, and then we're going to make certain modifications to it. And that's going to come to the state AGI, which then comes down to, after deductions and exemptions, comes down to taxable income. Then we go ahead and we do the deductions. So you got to learn which state does. Virginia, we do it basically where it's federal AGI, additions, subtractions for the modifications. That gets us to VAGI, which gets us down to our exemptions and standard deductions. And then from there, we get taxable income times tax rate. Boom, it's done. Whiz, bam, boom. And then excise tax. States typically employs excise tax subject to the federal excise tax. So if there's a federal excise tax on a product, they'll probably do a state excise tax in order to get their cut of the pie. Implicit tax, I'm not going to talk too much about this, but just kind of know it's an indirect tax resulting from a tax advantage the government grants in certain transactions, defined as a reduced before tax return that, good Lord, tax favored asset produces because of its tax advantage status. Difficult to quantify, but important to understand, evaluating relative tax burdens. My personal opinion, I've never talked to clients about implicit taxes, but it is something to actually kind of think about from a policy standpoint. I think it's very important. But for the most part, probably not going to talk too much about them. Alternative methods for evaluating tax systems. You're going to talk about things in terms of sufficiency, equity, certainty, convenience, economy, and I think that's it. And we'll see what they have in the other slide. But sufficiency involves assessing aggregate size of the revenues that must be generated. So in other words, do we tax enough? Can we cover our bills? Obviously, at the federal government level, no, we can't. It's because we keep bringing in less money than we like to spend. And that's because many people like to spend like drunken sailors. And being a prior sailor of mine, I have direct experience of this. No, seriously, we don't get sufficiency out of our tax system. Now, if they were to get sufficiency, it's going to happen one of only two ways: decrease spending, increase taxes. And of course, nobody wants to do that. So that's why we have what we have. Equity, how the tax burden should be distributed across taxpayers. Certainty, taxpayers should be able to determine the tax. And that's actually something I think that we've gotten closer to certainty in our system. Like I remember, hearing about tax systems that they had back in the 40s. Yeah, you paid 70%, but you got all these blooming tax deductions that if you didn't hire a CPA, you didn't take advantage of. And so really what was happening is, people who could afford CPAs, you generally could get better tax situations than people who couldn't. And so it was really the middle class that kind of took it in the shorts as a result of that. So, and, certainty, as we get a flatter tax system, I think we get more certainty because, it's just income divided by tax, income times tax rate is pretty much what it is without a whole lot of deductions. But, as we get more technology and better things take place, people can actually better understand and be able to take that stuff automatically. Convenience. Should we do, collect it without undue hardship? Say, for example, you had to pay your tax by driving to Washington, D.C. in order to deliver your money to the IRS directly. If you live here in the Washington, D.C. metro area, not a big problem. Spokane, Washington to Washington, D.C., not convenient at all. Okay. That would actually stink. So we're not going to do that. Economy. Should minimize the compliance and administrative costs associated with the tax system. I will let you make a decision as to whether we've actually succeeded in that or not, is what it is. So as we talked about sufficiency, like I said, types of tax, they're static and dynamic. Now, this is important when you're talking about, say, for example, they said, and a politician comes out and they're like, hey, we're going to give this tax cut and it's going to save this much money. It's going to save people this much money. Well, they're using static forecasting models in order to do that. And what they're doing is they're saying, if we reduce taxes from, corporate taxes from, say, 21% to 20%, this is how much revenue we're not going to get. What they're not taking into account is that there's going to be certain responses that are going to happen. Now, obviously, going from 21 to 20%, not a whole lot of responses. But when we went from 35% to 21%, oh my God, were the responses huge. I was a very busy man trying to, make a decision. Do we want to go C corporation status, S corporation status? It was a mess. And so it's definitely something that can be done. and all that sort of stuff. So, you've got that. And then when they do the forecasting, it's best to do dynamic forecasting. But the problem that you have with dynamic forecasting is they're going to put assumptions into it. And well, we know what assumptions is. It's, I remember the GAO, look, I understand GAO is part of Congress, but they're pretty a non-political organization. They're going to try to call a duck the way it is. Now, the way the GAO works is congressmen or congresspeople go to them and basically will say, I need you to do a calculation of the tax implications of this tax idea, but I want you to factor in these 5 things in order to take place. That's how they're going to do this. And so as a result of that, there can be some manipulation that happens. It's not because the GAO is trying to play tricks with the games, but they're kind of just responding to the customer's needs. GAO works for Congress, not necessarily just on their own. And so that's kind of one of the biggest problems. Now, does that mean that I think they're unscrupulous? No. I think the GAO does the best job they can with what they've got. And God bless them for doing the work that they do. Income effects. So they try to take it for income effects and substitution effects. Obviously, if I say I'm going to jack up rates on bottles of whiskey, what's probably going to happen? People are going to buy less whiskey because it's going to cost more money. And so there could be a substitution effect that actually happens with all of that. Equity, when we talk about equity, there's a horizontal equity and then there's a vertical equity. With horizontal equity, 2 taxpayers in a similar situation pay the same tax. And vertical equity, which is the greater ability to pay tax, pays more relative to the table. So if you think about vertical equity, that's why progressive tax rates really are kind of seen as a good thing. Because as you grow richer, you have more of an ability to pay that higher tax. Ergo, they're going to give you a higher tax rate. Horizontal equity, 2 taxpayers in a similar situation pay the same tax. That's really like if I got, I'm going to go back, like I'm a college professor and I got another college professor who makes the same amount of money that I do. Do we pay the exact same tax? If we don't, there's a problem. Okay. And that's the horizontal equity that everybody's kind of looking to achieve. All right. So I think that's all we've got for this lesson. I want to say thank you very much for watching class, and I look forward to seeing you in the next video.